We are continuing with part 3 of the narration on slide 10, and it deals with the effect of a tax. Now, it is important to note that a tax on output can have very different effect on a monopolist than on a competitive industry. So, although it was not prescribed to review the analysis of a tax on the competitive industry, I'm referring to the work covered in sections 9.6 of the textbook that was not prescribed. Please note that we are going to have a look at the effect of a tax for a monopolist. Um, so, the key thing to note here is that for a monopolist, the price can increase by more than the amount of the tax itself, whereas in a competitive industry, this cannot happen. So we are going to have a look at figure 10.5, which is going to show the effect of an excise tax on a monopolist. So the initial output and price is going to be given by Q0 at a price of P0, and that is where your marginal revenue is equal to your marginal cost. So here you can see your marginal cost curve and your marginal revenue curve, and where those two intersect, that is the initial output. And if you trace that up to your demand curve, which is also equal to your average revenue curve, that will give you your price of P0. So that is the initial position before there is the imposition of a tax. Now, with a tax, the monopolist has to pay the government the tax, that could be in rands or in this example in dollars, for every unit of output that is sold. So now that condition becomes marginal revenue is equal to marginal cost plus that tax. So now your marginal cost increases by T. So to find the output where profit maximization occurs, we need to check the intersection of our marginal revenue, which is this curve over here, and your new marginal cost plus tax curve, which is this dashed line over here. And you can see that they intersect at this point. So now your output is at Q1. So this is a lower output than before. And price, if we trace it up to the demand curve, is going to be P1. So price is greater and output is lower than before. Very importantly, take note that if you look at the magnitude of this change in price, it is bigger than this distance over here that is given by the amount of the tax in this case. So the change in price in magnitude was bigger than the tax amount here. And this is as a result of the elasticity of demand. So in this scenario, this was the outcome. However, you can have a situation where the change in the price is not of such a great magnitude in relation to the tax amount. Now we are going to move on to monopoly power, section 10.2. So as you read through your textbook, you will see that I've skipped over the multi-plant firm and moved on to this section. Now, figure 10.7 demonstrates the idea of monopoly power and how a firm is able to produce in a manner that price is more than marginal cost. So in figure 10.7a, we are shown the market demand curve for toothbrushes, as you can see here. And in part B, we see the demand faced by firm A. So firm A is one of the firms that make up that market demand in part A. Now we are told that there are 4 firms and they face this downward sloping demand curve, and the total production of toothbrushes is 20,000 per day. See this dashed line, and the price is $1.50. Also, the elasticity of demand for the market is minus 1.5. So that is the elasticity of market demand. However, as we're going to see, the elasticity for firm A is going to be minus 6. So as you can see here, this demand curve is more elastic relative to the market demand. Now the question is, how does this impact a firm and its market power? In part B that we are looking at for firm A, you can see that the production of toothbrushes is 5,000 per day by firm A, and this also applies to the other firms in the market because there are 4 firms, and that is at a price of $1.50. Now, let's say firm A wanted to raise its price to $1.60. Sales would fall to 3,000. And let's say firm A dropped its price to $1.40, it would be able to sell some more toothbrushes. So, unlike under a perfectly competitive market where a firm cannot raise its price because of its horizontal demand curve, here the firm does have some monopoly power to change price. And ultimately, the outcome is going to depend on things such as product differentiation and competition between the firms. So we saw that if they were to lower the price to $1.40, sales would increase for firm A to some extent. So it does have some degree of monopoly power. Now, the next example, 10.2, deals with elasticities of demand for soft drinks. Again, you can read through this example to understand how we can use elasticities of demand. The last sections we will look at deals with production price and monopoly power. So in figure 10.7, you saw that although firm A was not a pure monopolist, it did have some monopoly power. Remember, firm A was one of 4 firms, right? And it did have some monopoly power because it could have a price greater than marginal cost. If it had monopolized the market, then its monopoly power would, of course, have been much greater. So this raises 2 questions. How can we measure monopoly power in order to compare one firm with another? And then also, what are the sources of monopoly power, and why do some firms have more monopoly power than others? So, in terms of addressing these questions, the second question that deals with the sources of monopoly power will be addressed in section 10.3. However, in your 3rd year microeconomics, for those of you that will continue, it will be dealt with more extensively in chapters 12 and 13. Then for question 1, again, you haven't dealt with the rule of thumb for pricing, and this is also dealt with in 3rd year. So this is where you deal with the measurement of monopoly power. So just in terms of measuring monopoly power, you are not going to be required to measure it. Just understand it in a qualitative sense. So remember, there is an important distinction between a perfectly competitive firm and a firm with monopoly power. For your competitive firm, you know that price equals marginal cost. However, for your firm with monopoly power, the price can exceed marginal cost. And this brings us to the Learner Index of monopoly power, and that is a measure of monopoly power calculated as an excess of price over marginal cost as a fraction of price. And mathematically, it can be stated as such. But of course, this is also derived from your rule of thumb for pricing, which you don't do in your second year. So this index of monopoly power can be expressed in terms of the elasticity of demand facing the firm. However, you will not be tested on this. So we will conclude here, and we will continue next week with sections 10.3, 10.5, and 10.6. So remember, for this week, the learner index, the multi-plant firm, as well as the rule of thumb for pricing, is not covered at the second year.